Hi, everyone. I put this brain teaser up before we get started to get people thinking a little bit before we dive in. So if you haven't yet thought about these two questions, please take a second and answer them for yourself. In life, would you rather, one, be early or delayed? And two, would you rather pay a penalty or get a bonus? So welcome, everybody, and thank you for coming. Today I'm discussing Social Security planning, what you need to know about your retirement income. When your parents retired, they probably didn't overthink about Social Security. They just went down to the local office when they turned 65 or maybe 62 if they retired early and applied for benefits. They took their benefits for granted and didn't ask many questions. However, baby boomers approached the Social Security question differently, creating many problems. People are hurting their retirements by making terrible and costly decisions about Social Security. This is the main challenge we're trying to solve today. But before we do, I want to address a couple things about this presentation. First, you may be wondering why Tim is presenting about a government program like Social Security. It's a good question. Here's my answer. One, there's a significant need for Social Security education. People are interested in the topic, as you're watching this video confirms. Two, many uninformed people make damaging decisions about how and when they claim Social Security. And three, poor Social Security decisions make my job more difficult when I have to help clients develop retirement income plans to correct lower than necessary Social Security benefits. I also want to make two guarantees to you. One, I'm trying to make people smarter about claiming Social Security, and I believe you'll be better prepared to make good decisions after this presentation. And two, I want to assure you there will be no selling. This is purely an educational event. Now, to help you remember what we discussed today, I'll be offering a handout later that covers the critical aspects of the presentation. You can download it and refer to it later. And with the issue of Social Security, where everyone's decision is unique and personal to their circumstances, I'll invite you to come in for a complimentary meeting where we can just conduct a Social Security analysis for you and understand what strategy would be best to fit into your overall retirement income plan. And I'll tell you more about that a little bit later. One last thing about questions. Inevitably, you'll have them. But to get everyone out of here on time, I'll reserve taking questions until the end. As we go along, if you have any questions, I encourage you to type them in the chat and we can answer that question at the end, or if it's more personal, at our meeting. Let's dive in. A few things to know about Social Security. You have many claiming options. One couple could conceivably have up to 18,000 ways to claim, but we usually look at 5 most valuable scenarios. Your decisions have far-reaching consequences. Most decisions are irreversible after 12 months. Social Security is not bankrupt and it's not a Ponzi scheme. Social Security benefits probably help some people that you know, like friends or family. Yet at the same time, few of your friends or family have expertise in Social Security. And what we're seeing is that baby boomers want to know, will Social Security be there for me? You've been told for years the system is going broke, but now that it's almost your turn to collect it, is that true? You also want to know how much you can expect to receive. Before you retire, you've got to understand, how will you support yourself? That means doing a budget, lining up your income sources, and knowing how much you can expect to receive from each. Social Security, because it's a relatively known quantity, represents the foundation of that plan. You're also probably wondering when you should apply for Social Security. You may have heard your benefits will be lower if you apply early. But is it worth missing out on those extra checks for a higher benefit later? We're going to shed some light on that vital question today. Your parents probably never ask how you can maximize your benefits. Today, we'll discuss ways to maximize your Social Security benefits simply by knowing the rules and making intelligent decisions. You're wondering if Social Security will be enough to live on in retirement. Social Security represents about 40% of the average retiree's total income. But Coordinating Social Security with the rest of your retirement income plan, you can pursue a comfortable and worry-free retirement. Most people tend to minimize the value of Social Security, but Social Security is far more valuable than most people realize. Some people are worried that the Social Security won't be around when they retire. This has led to misunderstandings and irrational fears about the system's solvency. Let's look at what Social Security trustees say. Every year, they publish a comprehensive report showing the long-range outlook for Social Security. Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. The trust fund currently holds about $2.8 trillion invested in special issue Treasury securities. As baby boomers retire, the trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves to pay 100% of the promised benefits until 2034. After that, if nothing is done to reform the system, income will be sufficient to cover just 80% of the promised benefits. Although Social Security system is not in imminent danger, most people agree that the earlier reforms are instituted, the less painful they will be for everyone. Here are just a few ideas that have been proposed. One is to increase the maximum earnings subject to Social Security tax. Another reform proposal calls for raising the average retirement age as life expectancies increase. Currently, full retirement age is 67 for people born in 1960 or later. Still, another reform proposal would change the benefit formula so that future increases would happen more slowly. This would affect benefits for future retirees. Some are talking about changing the formula for cost of living adjustments. This would give retirees smaller benefit increases in the future, although the changes are expected to be minimal. The bottom line for baby boomers is that your benefits are not likely to be affected by much, if at all. So you can stop worrying about Social Security and whether it'll be there in the future for you or not. So, after thinking about that, you might be rightfully saying to yourself, what's a clearer way to think about Social Security? Here's a straightforward definition for you. Social Security is an inflation-protected income you can't outlive. As you'll see, your benefit could continue as survivor benefits even after your death. Your premium, or tax, is listed on your paycheck receipt under FICA and stands for Federal Insurance Contribution Act. You and your employer have paid a premium in every paycheck, so you want to be clever about how and when you collect this earned benefit. If you're worried about running out of personal assets in old age, you need not fear that Social Security, because it continues until you die, and of course, the longer you live, the more you'll extract from the system. If your benefit starts, say, at $2,000 per month, and you live 10 or more years, you'll receive nearly $300,000 in lifetime benefits. If you live 20 years or more, you'll receive almost $600,000 in lifetime benefits. If you live 30 years or more, you're likely to receive nearly $1 million over your lifetime. This assumes annual cost of living adjustments, or COLAs, of 2.2%. Second, Social Security offers annual inflation adjustments, 2009-72, and in 30 years, your check will be 3623. There's no way of knowing precisely what the future COLAs will be, but 2% seems very reasonable. Now, let's take a look at how much you can expect to receive from the system. When your Social Security benefit is calculated, it's based on how much you earned over your working career at the age at which you apply for benefits. The formula for calculating Social Security is pretty complex. I'll show you a couple ways to estimate your benefit in a moment. In general, the process goes like this. First, the Social Security Administration looks at your annual earnings over your lifetime, indexes them for inflation, and picks the 35 highest years' earnings to include in the formula. The indexed earnings are totaled and divided by 35 to create an average. If you don't have 35 years of earnings, the missing years will be filled in with zeros. This lowers Social Security benefits for people who have taken time out of the workforce, for example, to raise children. However, you may be eligible for spousal benefits, which we'll cover soon. You'll receive this amount when you reach full retirement age, which could be 66, 67, or somewhere in between. Each year, COLAs are applied to your benefit to help you keep up with the cost of living. Here's an example of how the benefit formula would work for a baby boomer born in 62 who earned the Social Security maximum every year since 22. His average index monthly earnings would work out to be $13,100. The first $1,174 would be multiplied by 90% in calculating his primary insurance amount. Between $1,174 and $7,078, or $5,904, would be multiplied by 32, and the amount over 7,078 or 6,022 would be multiplied by 15%. These amounts would be totaled to create a PIA of $3,849.10. This amount is what the worker would receive at full retirement age. Some of you may be thinking, well, it's good to know how they calculate the benefits, but why shouldn't I claim early at 62 instead of delaying to full retirement or even age 70? It's a great question. That's because your monthly benefit will be reduced if you claim early. Taxes may also reduce it, and Medicare premiums will be deducted, and your benefits could be withheld if you work. This means that even when you maximize your claiming strategy, the amount you receive will be smaller because of taxes and parts of your Medicare coverage. Naturally, this raises an excellent question. When should I apply for benefits? The decision of when to apply for benefits is one of the most important and complicated ones you make. It can make a difference between thousands of dollars in your lifetime. It's also important to realize that deciding when to apply for Social Security depends upon many factors unique to your situation. These include your general health status, your life expectancy, your need for income, whether or not you plan to work, or if you have a surviving spouse, what other personal resources you may have. That last part about the survivor needs, which we'll get into in a minute, also factors into this next question. For most people, Social Security benefits alone will probably not be enough to live on throughout retirement. Let's examine how claiming age impacts your benefits. When you can claim full unreduced benefits, it used to be 65 for everyone, but now, due to the 1983 amendments, we see a higher full retirement age being phased in. For everyone born between 1943 and 1954, full retirement age is 66 years old. For everyone born in 60 and later, full retirement age is 67. And for those born between 55 and 59, full retirement age is 66 plus some months to round it all out. Remember that your primary insurance amount, or PIA, is the benefit you'll receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, your benefits will be reduced. You'll receive a percentage of your PIA depending upon when you apply. And if your full retirement age is 66 and you use 62, you'll receive about 75% of your PIA. At 63, you'll get about 80% of your PIA, and so on. If your full retirement age is 67 and you apply at 62, you'll receive 70% of your PIA. These amounts are prorated monthly. On the other hand, if you apply for Social Security after full retirement age, you'll earn delayed credits of 8% for each year you delay. Your benefit will be 108% of your PIA. At 68, 116%, and so on. After age 70, though, you can't earn any more delayed credits, but doesn't pay to wait until after age 70 to apply for Social Security. In the future, there are ways you can easily find out approximately what your benefits will be. One is on your annual Social Security statement. It's now available online at www.socialsecurity.gov My Account. Second, you can use the retirement estimator Two, you can use the retirement estimator on your Social Security account. This calculator taps into your specific earnings history after entering your personal identification information, including your birth date, Social Security number, and mother's maiden name. Don't worry, the site's secure. Please note that the annual statement and the retirement estimator do not factor in COLAs into your age 70 benefit. This means your actual benefit is likely to be slightly higher than indicated, but our calculators adjust for COLAs. So if you know your PIA, we can help you project your future benefits. That's part of what we'll do should you decide to come in. Parent advantage delaying benefits is that your monthly benefit will be higher. A baby boomer with a primary insurance amount of $3,000 at full retirement age of 67 would receive $2,100 a month if they applied at age 62, but $3,720 if they waited till age 70. The difference becomes even more dramatic if we multiply those amounts by 2% annual COLAs. If the cost of living adjustment averages 2% for the next 8 years, their age 70 benefit jumps to $4,359. It might be hard to pass up security checks when you can start receiving them early, but if you live long, you'll be happy you waited. As you can see, the longer you live, the more income you'll receive by waiting until age 70 to apply. Naturally, you may be wondering, how can I maximize my benefits? Let's take a look at a couple strategies. First thing you can do while you still have time is to improve your earnings record. Check your annual statements to make sure your earnings record is accurate. Mistakes are rare because the earnings on file at Social Security were reported by your employers when they submitted your Social Security taxes. But mistakes can happen, especially if you're self-employed and your individual earnings are recorded from your tax returns. Next thing to consider is how you might improve your earnings record. If you do not have 35 years of earnings, can you work a few more years so those zeros can be filled in? If you had several years of low earnings early in your career, can you work a few more years while your new peak earnings replace the lower earnings years? Even if you start receiving Social Security, but continue to work, your earnings record will be updated. Applying for benefits at the optimal time is the best way to maximize your Social Security benefits. The chief reason for delaying benefits is that it will result in the highest lifetime benefit for you and your survivor. But this is not a one-size-fits-all answer to the question. The important thing is to apply at the optimal time for you. Did you know that Social Security benefits may be taxable? Let's look at some maximization of your benefits by minimizing your taxes. While the earnings test isn't truly a tax, it is a way in which the government takes back some of your income. So we're including that in the discussion. But it differs from the actual taxation of benefits, which we'll get into next. A crucial consideration when deciding when to apply for benefits is whether or not you plan to work. If you apply before you turn full retirement age in 2024, $1 of benefits will be withheld for every $2 you earn over $22,320. Now, knowing that this money isn't indeed taken away is essential. Instead, your benefits will be adjusted upward when you turn full retirement age to make it as if you had applied later. If some of your benefits were withheld due to the earnings test, your new benefit will be higher as if you had started at age 63 or 65 instead of age 62. So please don't let the annual earnings test discourage you from working. The more money you earn, the more money you will have. Social Security does not penalize you for working. Once the adjustment is made, you will benefit more from the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, wait until full retirement age or later to apply for benefits. Now, on the actual tax on Social Security benefits, this table shows taxation of Social Security benefits based on various income levels. Income means provisional income, which includes adjustments to gross income plus one half of your Social Security benefits plus tax-exempt interest. If your provisional income is under $32,000 for a married couple, no benefits are subject to tax. If your provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000, up to 85% of your benefits are subject to tax. The thresholds for a single individual are $25,000 and $34,000. Now, in the case of a married, filing separately but living together spouse, up to 85% of your Social Security is taxed regardless of your income level. You can minimize your Social Security taxes by lowering your other income, especially investment income. However, municipal bond interest, which is usually tax-free, counts as income to calculate your tax on Social Security benefits. Anticipate the required minimum distributions from your IRA, which may cause you to be in a higher tax bracket and may cause some Social Security benefits to be taxable. Consider drawing down your IRAs before age 73 or converting to a Roth, which generates tax-free income. Delaying Social Security will reduce the years your benefits are subject to tax. Consider reducing your expenses, pay down debt, adopt a simpler lifestyle to make do with less income. Continue managing your taxes through retirement, not just the first few years. Remember that if you are 65 or older and enrolled in Medicare Part B, your monthly premiums will be deducted from your Social Security check. As you can see here, if you claim early, your Medicare Part B will always eat up a more significant percentage of your benefits than if you wait until full retirement age or later to claim Social Security benefits. When to apply question is complex and requires a customized analysis. But here are a few points to remember. If you apply early, your benefit starts at some fraction of your PIA, 75 or 80% or whatever, and remains at that percentage for the rest of your life. It does not exceed 100% once you reach full retirement age. Cost of living adjustments magnify the impact of early or delayed retirement because the annual cost of living adjustments is applied to either the lower or higher amount. This causes a disparity to increase with each passing year. Your benefits may be taxed and further reduced by Medicare premiums. Don't let the earnings test discourage you from working. It's helpful for many. And finally, delaying benefits may give surviving spouses more income. That's an important point, especially if you're thinking on something like this. I won't live long, so why shouldn't I claim my benefit when I can? The typical answer to this question is couples, you should always maximize the higher earner's benefit to protect the surviving spouse, who will step into that benefit after the higher earner dies. Therefore, the higher earning spouses are encouraged to delay benefits to age 70, giving their spouse the higher benefits after they die. Let's first look at how spousal benefits work. Social Security was instituted earlier when most married women did not work. The program offers spousal benefits to give women financial security in their old age. It's important to note that spousal benefits apply to either gender, including same-sex spouses. We use wives in our examples because it's still statistically the most common scenario. Spousal benefit is 50% of the worker's PIA if she applies for it at full retirement age. So if John's PIA is $2,000 and Jane's PIA is $800, and if Jane applies for Social Security at her full retirement age, her benefit will be 50% of John's PIA, or $1,000. This is $200 more than her benefit based on her own work record. Here are some basic rules for spousal benefits. The primary worker must have filed for benefits. The lower earning spouse must be 62 for reduced benefits or full retirement age for full spousal benefits. Spousal benefits do not earn delayed credits after FRA. I'm sure you have a lot of questions about spousal benefits, so let's look at some ways to maximize them. The goal is to maximize income from both you while you're alive and maximize the income for your survivor after you die. By understanding all the considerations and doing some calculations, married couples can develop the right solution for their needs. Let's look at a couple of these strategies. When coordinating spousal benefits, the first thing to look at is this. Is the lower earning spouse's PIA more or less than 50% of the higher earning spouse's PIA? If the lower earning spouse's benefit is more than 50% of the higher earning spouse's PIA, maximizing lifetime benefits is for both spouses to claim their benefit at 70. Our calculators show this if both spouses have an average or longer life expectancy, this will maximize their benefits over their lifetimes. Now, if the lower earning spouse's PIA is less than 50% of the higher earning spouse's PIA, you may want to do a hybrid strategy. Here, the lower earning spouse goes ahead and claims early. This gets income started as soon as the lower earning spouse turns 62 or whenever the spouse stops working. The higher earning spouse still claims 70 to maximize the higher benefit over both their lifetimes. It can be very complicated, especially with the recent rule changes, and you need to run the numbers, which we can do for you. And I want to remind you that I'll be happy to run a series of maximization scenarios to help you identify the best claiming strategy, whether you're single, married, divorced, or widowed. Let's continue to take a look at how survivor benefits work. Since you may be thinking, well, I'm widowed or divorced, so how does that impact my Social Security claiming strategy? It's an interesting question that has a very satisfying answer. If you're widowed or divorced, you may be eligible for survivor benefits, divorced spouse survivor benefits, or divorced spouse benefits. By coordinating these benefits with your record, you may be able to increase your total benefits. But first, let's look at the basic survivor benefits a spouse would receive, hopefully after maximizing the other spouse's benefit. Survivor benefits can be somewhat complicated, but it's essential that you understand how they work because the decisions you make now can influence the amount your survivor will benefit later on. Two factors that influence the survivor benefit. First factor is the age at which the deceased spouse claimed their retirement benefit. If they originally applied for Social Security benefit before full retirement age, the survivor benefit will be limited to the actual amount, or 82.5 of their PIA, whichever is higher. The survivor benefit will equal 100% of their PIA if the deceased applied at full retirement age. If they applied at 70, the survivor benefit will include any delayed credits. The second factor influencing the survivor benefit amount is the age at which the widow or widower claims it. If they claim it at 60 or 50 if disabled, the survivor benefit will equal 71.5 of the deceased PIA. If they claim at full retirement age or later, the survivor benefit will equal 100% of the original amount. They may apply anytime between the ages of 60 and 70, and the reduction will be prorated. If both spouses receive benefits and one spouse dies, the other may switch to the higher percentage. Let's say Joe and Julie are married. Both are over full retirement age and receiving Social Security benefits. Joe's benefit is $2,800, Julie's is $1,500. If Joe dies, Julie's $1,500 benefit will stop, and she will start receiving $2,800. Most widows and widowers need at least 2/3 of the amount of their income they were receiving as a couple, so it is essential to plan for the loss of one spouse's Social Security benefit. Even though it's often the higher benefit that will be retained, the death of a spouse means the loss of one Social Security check, regardless, which means less money coming into the household. Now, let's see what would happen if the deceased spouse delayed starting Social Security. In this hypothetical, Joe files for Social Security at age 70. His benefit is 124% of the $2,800 PIA for a total benefit of $3,472. If he dies, Julie's survivor benefit will equal Joe's benefit of $3,472. Survivor planning is an essential part of Social Security planning. Decisions you make now can influence the surviving spouse's standard of living the rest of their life. Here are some rules for survivor benefits. For the surviving spouse to receive survivor benefits, the marriage must have at least lasted 9 months, unless the death was ruled an accident. To start the benefits, the survivor must be at least 60 or 50 if disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced, as it was with regular retirement benefits. Some of the same principles that decided when to apply for regular retirement benefits also apply to survivor benefits. You may remarry before age 60. You will not be able to receive the survivor benefits based on your own previous spouse's record unless your remarriage ends. And divorced spouse survivor benefits are available if the marriage lasted at least 10 years. A divorced spouse can receive Social Security benefits on the ex-spouse's work record, provided the marriage lasted at least 10 years and the person receiving the benefits is currently unmarried. Remember, men can also receive divorced spouse benefits. If the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his or her benefit whenever. However, he must be at least 62 years old. Here are the rules for divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. So, if one spouse has remarried a couple times, the 3 ex-spouses can claim divorced spouse benefits as long as each marriage lasted at least 10 years. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or the ex-spouses. You do not need to know the ex-spouse's whereabouts, only enough to identify the information like the Social Security people can look up your records. You'll need to provide documentation showing the marriage and divorce dates. If you receive divorced spouse benefits and remarry, your benefits are going to stop. However, based on your new partner's work record, you may be eligible for spousal benefits. Of course, you can switch to your benefits if you qualify for Social Security. So, if you're thinking, gee, this really is more complicated than I realized, I understand. I didn't realize much of this until I educated myself because it was clear to me what an important role getting Social Security right plays in people's retirement income plans. Which brings us back to our Social Security brain teaser. You may have heard the phrase behavioral finance. That's the study of psychology's influence on investors' behavior. So, for our brain teaser question, people usually say they'd rather be early than delayed for many things, and they'd instead get a bonus as opposed to paying a penalty. And that makes pretty good sense. But as we've seen in our presentation regarding Social Security claiming strategy, early is to penalty as delayed is to bonus. The government didn't set up the phrasing this way intentionally, but it certainly has influenced people who have only seen their claiming choices described as early versus delayed. We don't usually see the claiming question positioned as one of penalty versus bonus, but I think you can see the value in framing the question in that manner, right? Review what we've learned and then close with the solution. So here we go. This is what we started with as our core challenge. People are hurting their retirement by making terrible, costly decisions about Social Security. Then we went through the 4 insights designed to help us understand the problem and develop a belief in the solution that might work. In brief, the insights were Social Security offers inflation-protected income you can't outlive, including survivor benefits. Your monthly benefit will be reduced if you claim early. Couples should always maximize the higher earner's benefits for the surviving spouse. And if you're a widower or divorced, you may be eligible for benefits that can increase your check. And so that understanding of the problem brings us to this solution. Everyone needs a personalized Social Security claiming analysis to understand how and when to apply for their monthly benefit and how it'll fit into their overall retirement plan. Social Security in the context of your other retirement resources. This includes pensions, IRAs, 401ks, the required minimum distributions you'll be needing to take at age 73, your overall investment portfolio, and your plans for working in retirement. These resources should be coordinated to give you the income you need for the rest of your life. Now, please don't be afraid to ask for help. Retirement planning is actually very easy when it's all about stashing money from your salary into a 401k or IRA. But when it comes to you starting to convert your nest egg into a stream of income, you want to make sure it doesn't run out. And Social Security may be the bedrock of your retirement income plan, but it must be coordinated with your other resources to give you the stability and the security you deserve. Now, the Social Security personnel are very helpful, but they can't make recommendations. We, however, can help you. Analyze the claiming strategies, show you your Social Security income stream under different claiming scenarios, and help you take advantage of innovative strategies designed to help you maximize your benefits. We've covered a lot of ground today, and you probably still have a lot of questions like, when should I apply for Social Security? What if I want to keep working? What if I've already applied? How much will my benefits be? How can you coordinate spousal benefits? What's the best long-term strategy for my situation? And what should I do next? We'd be glad to help you consider these questions individually and help you devise a plan for your specific situation. Social Security is too important for guesswork, so let us help you protect your nest egg and maximize your income in retirement. The best way to complete a custom Social Security analysis for you and your spouse. Run a series of maximization scenarios to help you identify the best claiming strategy, whether you're single, married, divorced, or widow. Please use the calendar link to claim a spot on my calendar.